For some reason, there we go. So I'm the client service specialist for the Carrot Project, and in case there's a few of you out there who don't know much about the Carrot Project, I'm going to spend just a few minutes, or even maybe a minute, telling you a little bit about the Carrot Project. We work both locally and further afield, and focus on creating networks of support to fill the gaps in services available to farmers and local food businesses. You can see here on the screen our vision and so on. I'll give you a second to read it before I move on. And we work with a wide variety of businesses. And after this series, you may want to work one-on-one with an advisor on your own business plans. And our programming is designed to provide this one-on-one support. So reach out to me anytime you'd like to get help. And somebody's going to put my email in the chat. It's also at on the last screen of this presentation. So don't feel like you have to write it down. I'm sure you can Google me and find it as well. Just a note of caution, we have some numbers in here. They're fabricated. They're not going to help you if you try to use those numbers for your business. So please don't. Much of what we're going to talk about today will be cash assets, but the tools apply to non-cash assets too. Almost every action in the business has a financial impact or a footprint, and we can use numbers, both past results and future estimates, to help us decide what our best options are for achieving our goals. There's no magic formula. Our strategies take work and revolve around planning. And numbers require context, who you are, what you want, what you and your assets are capable of, and of course, what you are willing to do. This context is what helps us ground our plans in reality. And if we keep up on our books, we can use numbers to monitor progress towards our goals and make adjustments along the way to ensure we get there. So the strategies usually the most helpful in planning and managing assets when net income varies are the skills and tactics used for financial planning and management. It means working with numbers and concepts, and so not so much with your hands. So before I lose you all, let's be honest. It's not the kind of work most food business owners find inspiring. If you did, you'd probably be in another field, like maybe a financial officer or an accountant or a bookkeeper or a banker, or maybe work for the IRS. Who knows? But the work can be manageable. It will get easier with practice, will yield positive results for you, and there are experts to support you in the work. The caveat is that each of us will have a different system for making it work. We all come to the table with different skills, knowledge, generational support or lack of it, immediate family concerns, access to experts and professionals, and values, which impact what will work best for each of us. So though we can find tips from others on how to do it, it's not likely we can exactly replicate our system from what other producers do. When thinking about investing in your business and or improving profitability and consequent consistency of income, think about improving efficiency of your most important or expensive resources, reasonableness based on scale, and production plans and practices that help to moderate your most significant risks. Often key crops or products, major equipment and infrastructure, and labor top the list of elements to focus on. A little bit about scale. At the laser weeding session at the New England Fruit and Vegetable Conference a couple of weeks ago now, we heard it costs at least $1 million and often more for a laser weeding system. Literally at that point, 50% of the room got up and left. And that's because, let's face it, $1 million is usually not very much scale appropriate for most of us in the Northeast. And what about risks? Things like fields prone to flooding or drought, crops likely damaged by frost, sales channels significantly impacted by weather like farmers markets all come to mind. For fishers, pollution, water temps, migrating species, days, and the times of storms might all be significant risks to consider. Overall, we're saying when you're thinking about making these plans, make a list. Maybe call it a wish list with priority designations and costs for the items and practices that will help solve your biggest issues. Include what your sales goals are with those things in play. And keep it handy. Look at it regularly and update it as things change. A spreadsheet can be an effective tool for your list, especially for making updates to cost and revenue. I think it makes sense to consider health insurance an investment in your business and put it on your list. Because without your and your family's health, and if you have employees, their health, you won't be able to run a business very well. This is not to say we're saying plan on paying full freight for insurance. Rather, in your financial planning, treat it as an investment, whatever your net cost is expected to be. Overall, generally, what you decide to do today does not stop you from doing other things on your list and new ideas in the future. So it's not usually helpful to worry about that. Just assess the opportunity when the time seems right. Here's a simple example of a wish list spreadsheet. Deciding timelines for plans is just as important as deciding on our plans. Business planning tends to break things down into 1, 3, and 5-year timelines, so those are often good timelines to use. This example is a 1-year timeline. Since you may be making decisions 5 or more years out, don't discard your work. Save it for when the right time comes, which may include when grants are available. You'll have a big leg up on writing your grant if you saved your work. And finally, let's acknowledge that what you need and want and the risks you are willing to take as a young single farmer or fisher aren't likely to be the same when you have a family, get older, and as you approach winding down your career. So this work isn't one and done. Rather, it's a process. You should find it helps you create and maintain a viable business over your whole career. Hopefully, you will find it very helpful and develop some incentive to do the work. Many of us enter into the work hire mindset. It really doesn't help with realistic planning, record keeping, regulatory compliance, or planning for profitability if you're already maxed out or past it. Some key workload strategies for all planning work: bite size. Work in smaller increments. Don't wait until it's too big to manage, because yes, then it is. This idea applies to big projects or expenses in particular. It's often safer and better financially in the long run to make incremental changes rather than jump into big things all at once. For instance, while you may know that in 5 to 10 years you'll need a 90 horsepower tractor if your plans come to fruition, if you only need a 40 horsepower tractor for the next 5 to 8 years, the added expense of the bigger tractor very well may sink you before you're able to take advantage of it. So the smaller tractor is the better choice. For planning, spreadsheets are so much more time effective to manage than paper or most accounting and bookkeeping software programs. Google Sheets work, sort of, right? They don't have all of the ability to use all the formulas that Excel has. OpenOffice and similar open source software are better options than Google Sheets. Our templates are in Excel and will work better with OpenOffice than Google Sheets. And I encourage you to look online. You can get Microsoft Office either for a PC or a Mac for under $30. I won't warranty that those websites are safe. There is a website that we use. It's called Mr. Shopkey, and I looked this morning for Office. And they have older versions that are $49 and $59. The most modern version is, I think, closer to $200. But my point is saying that to do good work, spreadsheet work, you want to have some good software to help you manage it, and it might be that it's well within your affordability range by looking online and providing buying an online copy. So. Carrot and other service providers are here to help you work smarter, not harder, to increase income and wealth and improve your work-life balance. But we know most business owners have an independent streak, and that trust in others often comes slowly. If you're not part of a multi-generational business, it can be challenging to find support and to develop trust. If you test a few options, You might get different, perhaps even conflicting advice, all the more problematic. Probably the best advice I have is to ask successful business owners in your network who they like and why, and try them out to see if it seems like a good fit for you. And by the way, my presentation is not going to take the whole hour, and I encourage you all to interrupt me with questions as we go along, versus waiting to the end. But certainly, if you're more comfortable waiting to the end, we can deal with it that way as well. The four elements: cash flow, cash position, net income, and your balance sheet are the basis for evaluating what to do with your money and when. And two key elements of these are cash flow and cash position. Cash position is the same as cash balance and typically automatically includes net income in the work that we do. Even if you are planning changes, projecting financials for at least cash and flow and cash position for the next year, or maybe more depending on your plans and goals, with no significant changes except inflation, forms a solid base to understand what the real impact of any change you make is. In the past 10 years, we've seen the wettest and driest years on record in a lot of New England weather recording stations. Set yourself up to introduce multi-year cash flow planning with a 1 year and 2 not good year scenario in a 3-year cycle. Now, for a lot of us, that's kind of terrifying, right? Both the weather and 2 bad years for every 1 good year. But we think it gives you a real sense of what your likely range of scenarios will be. And we're going to talk now about how to use your own data to come up with your own individual range. So key strategies for doing this work is to create a budget spreadsheet for your operation that is both a profit and loss budget and a cash flow budget. If you have accounting or bookkeeping software, use its profit and loss exports for your income and expense line items. You want your projections and actuals to have identical rows. Consider reorganizing your book if it's not organized in the way that you need it or want it to be to quickly get the information you need for meeting your planning goals. Schedules F and C are for paying taxes. They're not for managing businesses, and it's usually not the best to organize your books around those schedules. It takes more work to extract the information you need to make decisions if that's the way you choose to organize your books. This data is a simple spreadsheet that is a hybrid between a profit and loss above the line and cash flow below the line for 3 different years: 1 good, 1 so-so, 1 not good. How much detail you want to put in your sheets depend on the goals you have, and if you have more than 1 key element or enterprise in the business. In any case, organizing it so it shows the information you most need for making decisions to meet your goals and organizing it into fixed and variable expense sections is really helpful. You need to organize into variable and fixed expense sections for calculating cost of production and break even, which are 2 key elements of understanding profitability and the things that most impact your profitability. With your template, if you've been in business for a few years or more, find a really bad year. For farmers, maybe that's 2021 when fall crops were a real problem for many, or 2018 when there are no peaches and there's a pretty significant drought, or maybe 2023 if you were flooded. Generate the numbers for that year in your template. Find a really good year and generate those numbers. This gives you good, worst, and best case scenarios to use as a basis for your analysis. With 3 or more years, more better, of course, you can generate an average that may be helpful. Calculate what your break-even sales were or would have had to be in each of your good and bad sample years. If you create an average year, then also for that. Break-even can be a measure of efficiency or changes in efficiency as you implement change, as well as help you evaluate how realistic in general your ideas or goals may be. And we'll have more on break-even in a bit, but in general context, you can use break-even sales to say, let's say you're grossing $200,000, currently, and you have some ideas, and And you put them into the spreadsheet and you figure out what your revenue is going to be, but at the same time you can calculate your break even. And if the break even number turns out to be somewhere in the $800,000 range, you can say, okay, well, that's well more than double what I'm currently doing, and it gives you just a perspective, right, to measure how realistic that idea might be, given all the things about your business and your markets and so on and so forth. Now, Carrot project templates are all set up to allow you to relatively easily, in terms of formulas and so on, do all this work. We talked about organizing to extract meaning. Here is a sample that we have, a very simple, what's called chart of accounts, and we're laying out here that you have some operating expenses that are broken down into variable costs and fixed costs. They're very simple. These are not the only direct line items that we're saying we're recommending. It's just a simple example of how things lay out. And typically in spreadsheet software, or even in handwritten ledgers, right? You calculate what your operating income is. That's your business income, so to speak. And then there's other income and expense, grants, depreciation, and so on. These are items that aren't always directly related to the production, the product that you're producing and selling for your business. And it's very helpful to segregate those two things so that you have a better understanding of what the business is providing, what other elements or associated things to your business might be providing, and allow you to better analyze the business changes and the business expenses and the business income versus those other things. With your spreadsheet template, you're going to create budgets for implementing your plans, the plans that are based on your wish lists, and compare your expected cash flow, cash position, net income, and break-even points. These provide the basis for money management strategies for growth, health insurance, retirement, and so on. When you compare your projections to your best and worst case scenarios, you gain greater insight into what your plans mean for the money and other assets other asset management that's needed to achieve that plan. It also allows you to see or think about other options that may exist. And after deciding what you will do, for knowing what numbers to look for and when during the season to track your progress and make adjustments if needed, and to re-estimate your financial position at the end of the year. At this point, it's a good time to talk with financial planning experts and prepare the actions required to meet your financial objectives. It's ideal to do this in advance so that you are not under stress to do that planning work at the same time you're acting, right? And making changes to your business or running your business, or whatever the case may be in terms of the actions. Here's a little bit more complex example of a spreadsheet using our spreadsheet example. It's part of a workbook with formulas and automatic transfer of information between sheets, which really simplifies the work burden. And again, this is just a quick summary so that you could see everything on the screen. I don't have an extensive list of expenses, or just be too long to show on your screen, but I wanted to give you an idea of what the spreadsheet that we have looks like. So how do you know if it's likely to be profitable? By knowing what your cost of production and break even is. If your cousin is a CPA, this is what they mean when they say break even. That's not the Carrot's perspective. We advocate for a different approach. We add debt service and a certain amount of profit to your break-even analysis in order to plan for profit. And now let's talk a little bit about fixed and variable expenses, or costs. Variable expense is an expense that correlates closely with production output. And you see some we got listed. Other typical variable costs are packaging, fertilizer, and other production inputs, consumable supplies like disposable drip tape or ice. Fixed costs are not costs that do not change. They are simply those costs that do not vary directly with your business volume. Rent, typically insurance, accountant, bank fees that we got listed here, some other things, our phone, internet, property taxes. An expense like electricity could be both. And to explain that, I'll say, let's say you're running a cooler, right? And you also have an office and you have the lights and, et cetera for the office. It's not likely that you're going to have the lights on significantly more if you have twice as much business. But if you're running a cooler and you don't run it when there's no product in there, and you double the amount of product you're putting through, more than likely you're going to run it more often. It's certainly going to run longer if you put more product in to bring temps down. And you could argue that those electricity costs are a variable cost, not a fixed cost. So it's not critical to get it perfectly right, but to do a good job in trying to, sort this out is really helpful in terms of figuring out the metrics of what you're making money on and potentially what you're not making money on. I'm going to pause right there because there's often questions or conversations about fixed and variable costs, and just ask, does anyone have any questions or observations on this?
Feel free to come off mute and ask a question if you do.
I guess not. Put it in the chat if you do. All right, so the break-even analysis. This is the formula for the break-even analysis. I'm not going to go into depth with it, but this is just algebraic manipulation of the way numbers are tracked in financial record-keeping systems. And what we come up with is your break-even sales is equal to fixed costs plus desired profit. In our case, we add debt service to it, divided by 100% minus the variable costs. The variable costs, though, which are also your costs of production, by the way, are expressed as a percentage of gross revenue. It's not your actual number, it's the percentage of gross revenue number that you use to calculate it. So back to our example. And in their planning, the owners decided that they must generate at least $25,000 in net income, and that ideally they don't go over $50,000 in order to maintain health insurance subsidies. With this information, they want to test how easy or not it will be to make at least $25,000. And of course, they've already set up their spreadsheet here to determine, what it's going to look like if they just make under $50,000. So in using our break-even analysis, there are certain numbers that you're gonna focus on. You're gonna focus on your gross revenue. You're gonna focus on your variable expenses as a percentage of gross revenue, your fixed expenses, and debt service. And of course, we already know that they said we need to make at least $25,000. So with this in mind, you put it into the formula, and you can double check my numbers, but I've done it. What this shows is that for them to net $25,000, they're going to need at least $115,500 round numbers dollars of sales. Based upon the fact that if things go well, they are anticipating $160,000 worth of sale. The point in this is saying that's a pretty significant percentage of their total projected gross, which means there's not a lot of room for variance. Now, they've also laid out what it looks like to generate just under the 50,000, as I pointed out, and can use the numbers on the monthly basis to assess during the year if they are on track or not. So again, they can look at their monthly projections. If you keep up with your books, you can look at the reports from your books, and you can see where you are. And depending on where, whether you're close or not, you can decide what you're going to do to, fix the situation, so to speak. Or if you're way over, I suppose you can decide, what that's going to mean. You can put it back into your spreadsheet if you're way over, and you can see what that means for your net at the end of the year and start making plans to adjust this with various strategies that you might use to employ, but start doing it sooner rather than later, which might be better and more efficient, better way for you to understand to not purchase things that aren't ultimately in the long run going to be helpful to your business. Good scenario planning is followed by a sensitivity analysis. It helps tell how likely you are to make a profit and how risky the enterprise may be. You may have noticed we've already baked in a sensitivity analysis into our process by generating best year and worst year numbers. These may be sufficient, or you may want to test other scenarios around what if things go well or wrong, if you like doing this kind of work. So back to our spreadsheet. This slide tests investing $35,000 of cash into the business with a hedge of pulling out $4,000 in cash for an emergency fund around the timing of the equipment being first used the following year. And expensing the purchase, meaning you're just going to write it all off in the 2025 year. This same spreadsheet can be used to calculate depreciating your equipment, or choosing a combination of expensing and depreciation and seeing what the net results are. So as you see in our slide here, they take the $35,000, they're applying their equipment in November, and it brings their net down to $10,500. In this slide, they're saying, you know what, we're going to test out, we're going to take $15,000 and we're going to use that cash, right? And we're going to depreciate the rest. And you know, you can go look at depreciation tables from the IRS. And the bottom line is, you can see that by you know, a relatively small change in terms of percentage, right? Instead of the 35, they're only taking $15,000 in cash, and you know, they end up with significantly more net income. And again, I want to point out that right here, right, this is what they decided. Originally, they had $8,700 in the bank that we're projecting going into the year, which you need this number to do your cash flow balances here. But at the end of the day, they decided they're going to take $4,000 and put it into a different bank account, if you will, reserve it, right? So that if the equipment is delayed in getting to them and set up, or at the end of the day, if they don't get into their projections for increased sales the following year, they want to have $4,000 in the bank to cover the potential cash flow issues early on in the season. Now, you can see they get down to negative numbers here in July, right? And they're saying, hey, you know, we need to have some money just in case we don't get our act together and you know, get next year in 2026, you know, get this equipment up and running and improve this number right here. Does that make sense to folks? Okay. Here are some goal types and metrics used to evaluate them. You do not need to understand how or when to use each analysis tool on your own. You can work on these things with the business advisor at the CARE project. And an outside perspective is often helpful in planning work anyway. When working to understand when to make the leap to self-paid health insurance, and probably for major investments, sensitivity planning focused on reducing variance in net income can be key. And I talked earlier about, you know, balance sheet is one of the key tools to use, and balance sheets are certainly complicated and not everyone's cup of tea, so to speak. So I'm not going to go into the details of balance sheet. This is an example of the balance sheet of our sample business. And you can see, you know, how this lays out given the scenario that we created in the background for this business. What I do want to talk about is consider having a consolidated business and a personal statement, because ultimately it's the combination of both that generates your financial security and your options. So as you get at the end, you've done your planning, you've looked at your balance sheet, you understand, where your assets are, how much wealth you have, how much free capital, so on and so forth. Once you finally understand that, once you finally understand what you think you will end up with in any given point in time, again, usually a year, maybe 3 years out, 5 years sometimes for if you're looking to get a loan, but beyond that, there's so much variability and the risks that we have as producers that trying to plan more than 5 years out often is a futile experience. So in any case, when you're at the point where you've got some numbers and you're just thinking about managing, longer term strategies for managing that money, right? Some things you might want to think about and talk with experts on are income averaging. Income averaging is an approved IRS approved way of evening out net income only for farmers and fishermen. It's not available to everybody in the world. But last week, for those of you who might have been on, we talked a little bit about alternative Social Security payments. Farmers and fishermen, again, the only two businesses that the IRS allows us can use the alternative formula to pay into Social Security and develop both dollars for your retirement, assuming Social Security is going to be around when you retire, as well as quarters, months that apply to quarters. You may know that you need to have a minimum number of quarters of participation to qualify to get the benefits. So, because I think the government understands that farmers and fishermen oftentimes operate with no income, it allows you to voluntarily make a payment when you wouldn't have to. It allows you to voluntarily increase your payment in case you want to use those dollars for your retirement planning. Of course, and I probably talked a little bit about this, and I'm sure you'll talk with Gather Wealth Management more about these ideas, but pre-tax retirement, investment, and medical accounts. And we talked about purchasing equipment or other productive assets. Land and buildings are part of that. That the budgeting shows is a good investment for the business and improves the bottom line. Right, and allows you, again, as we did before in our exam here, to evaluate the use of depreciation or deductions or a combination of both to manage your net income. Ultimately, particularly when you buy assets, the strategy may improve your wealth if the asset still has value at the end of your life, of their lives, I'm sorry, in your business. All right, any questions at this point?
I'm not seeing any in the chat, and people, again, can feel free to unmute themselves and ask.
Sure, no, okay. So that's the end of the slide presentation. There's my contact and Carrot's contact information. Love to hear from you. If you want to talk more in depth about these ideas, work with an individually with an advisor who's expert in using our spreadsheets and helping you do some planning, whatever the case may be.
Thank you, Jeff. That was great. We're going to open it up for questions. If anyone has a question, again, you can unmute yourself and ask, or you can put it in the chat if you rather.
Jeff, what is usually the cost to work with the Carrot Project? What's the process for getting started with you? Is there what kind of farmers would you be working with? If you could explain a little bit about that.
Sure. Okay.
I'd really appreciate that. This is
so
great.
Yeah, thank you. Thank you, Matt. So cost, free or a portion of the actual cost. Our model, our system is we write grants and we then pay the business advisors directly on the client's behalf. And that does a couple of things, not the least of which it removes the farmer or fisherman from having to get involved in grant reports. Just so you all are aware, part of my role is, collecting all the information and submitting many of the, reports required for all these grants that I write. And probably 30% of my day, if you will, is spent on that work. So it's pretty significant burden. And so, we take it on. So we base the kind of the bottom line metric that we base the percentage of payment on is household income, and we use the HUD guidelines. And we have a formula, but that's just a starting point. And I'll use this as an example all the time. There are plenty of times where we have clients who have, reasonably high compared to HUD household incomes. In this neck of the woods, that means, somewhere around $100,000 or so per year. But they have children and they're paying, $20,000-$30,000 a year for childcare. That makes a big difference in terms of, in our perspective, in terms of capacity to pay for the services. So we factor, that type of thing into our thinking. The process is you can reach out to me. We have a form, we call it our inquiry or request for support form, that collects information that we need to collect. That's part of reporting back to our funding sources. We aggregate that information. We do not provide individual, personal data to our funders, but we do need to, collect a certain amount of information to make it free or inexpensive for folks. There are times where the work required is not in our expertise, and we will work to refer folks to outside business advisors who just would work independently with you. A good example of that might be if you have books and they're a mess and you need a bookkeeper to fix them, our consultants will work with you to point out the challenges and the issues that need to be resolved. And they might spend, an hour helping you make some corrections. But if you need a lot of corrections, we're going to refer you to a bookkeeper to hire independently of us, so to speak, to get the books fixed. And then with the good numbers, we can start doing the work that we focus on, which is the financial planning, access to capital, that kind of stuff. Access to capital means getting a loan or a grant. We'll review grants. We won't write grants for you, but we review, comment, make sure that you're meeting all the grant requirements, right? That you have budgets that work for the grant and are reasonable and basically implementable. And I will tell you that we always say this: grants are not free money. Grants are a lot of work. There's usually reporting requirements, right? And ultimately, with FSIG and some of the other grants that have been available lately, there's one thing that we've observed is that almost no project has come in on or under budget. And meaning that to get your grant money, because it's reimbursable, you got to put out more money than you planned. So in our process, we always try to encourage farmers to, in their budgeting, to build a fudge factor and to make sure that you actually can implement the project, because you get 90% of the way there, right? And you don't have the cash to finish it. You got a big problem because you're not getting much or any of your reimbursement, depending on the grant program and how it's written and how the reimbursement protocols go. But the point is, we've seen a lot of farmers with FSIG in particular end up in really challenging situations because of cost overruns on the grants, and something we want to make sure people are aware of and are cautious around. Matt, did I answer all of the questions that you asked?
Yes, you did, Jeff. Thank you so much. That was
And
great.
I'm also dropping a link in the chat. Jeff and Gather and people from Carrot Project and Gather Wealth will be offering one-on-one coaching sessions at our conference. So you can use that link to actually sign up for a one-on-one session with both Jeff. I think there's going to be one other Carrot Project person, and also Gather Wealth, who are our speakers next week.
All right, I'm going to stop sharing my screen if everyone's okay with that, so you don't have to have that taken up. Anyone object?
So Jeff, if you've estimated a good year, you've estimated a bad year, what if you have an exceptional year and didn't sort of anticipate that, and now you have this extra money that, you know, you have to expend. What are some options for farmers that they can do with that money?
Well, of course, many farmers, or fishermen probably use this strategy, which are, you purchase supplies, for next year, later in the year. That depending on your accounting system, right? If you're counting on a cash basis, it works very well. If you're counting on an accrual basis, technically, it may not work particularly well because the government says on an accrual basis, if you pre-purchase supplies, you put them into inventory, you don't write them off from your income. And you may or may not follow those rules. And if you don't get audited, then it won't be a problem. But if you do get audited and you don't follow the rules, it could be. But anyways, we all know that that's one strategy is a pre-purchase, and it's not a bad strategy because it's expenses you're going to have anyway, and oftentimes, as you may know, you get discounts for purchasing next year's supplies early, and so that lowers your costs, and that's always a good thing. The caveat is you got to have the cash flow. It's not just having a net profit, right? It's actually having the cash to make it worthwhile. I suppose there could be a scenario where you have the cash in the bank now, and you have to report it as income if you don't do something with it. And yet, coming up, if you're farming in this neck of the woods, you're going to have very little or no income, coming in December, January, February, March. And if you look at your household living expenses, and it uses up all of that cash, so that you're now borrowing money in April and May to get the business going, the savings may not have been worth it, right? The savings in terms of your discounts may be less than the cost of borrowing money and the hassle of having to borrow money and so on and so forth. So, I guess I'd recommend considering other strategies. Income averaging. Again, I'm not an accountant. I'm not a tax professional. I'm not providing that type of advice. And to talk to, somebody who's a tax professional about income averaging and see how that impacts. Essentially, income averaging is you're going to take some of that banner year and you're going to apply it to 1 year prior and to that year and 1 year forward. That's the rough system that the IRS allows. So you got to work your numbers. You got to use your spreadsheets. You got to figure out what your net result is for each of those 3 years. As I know, we're focused on health insurance and health insurance subsidies, right? Working with I guess the insurance agent, find some support, right, for insurance support, and find out how that's going to impact whatever you paid. And when you readjust your income for the previous year, what's that going to mean for your subsidy? Do you have to pay back some of it? All those impacts, that has to be part of the equation. But it is certainly a strategy that could be reasonably used more time to time when you have a really exceptional year, right? That's probably when it's best employed. I don't think it would necessarily be a good idea to plan on doing it all the time. Like if you're growing, right, to eventually the work is not worth the effort, and you plan your growth, you understand your growth. And that's the scenario where you're using your spreadsheets to determine, hey, at this point in time, if I stay on this growth curve, I'm going to lose my subsidies anyway, and for health insurance, and now I want to include the cost of health insurance, in my expenses, and at least get to write it off. And I think there are strategies around doing that in terms of the business strategies. There are strategies around that for self-employed health insurance deduction, the tax credits and all that type of stuff. So again, working with professionals who really understand those details is how you manage it. We talked, I mentioned, before, the pre-tax expenses. So health savings accounts, I don't personally, like flexible spending accounts, because it's usually to lose the money, although on an individual basis, I'm not sure quite how it works. But a health savings account goes into that pool, and it's your money. It stays there in the pool, whether you use it or not. It can build over time. I'm assuming, right, again, talk to tax professionals. There are tax consequences if you pull it out, for other purposes, or if it just sits there forever. I don't know. So I'm not saying it's a perfect solution, but it's one thing to consider. Again, it's investing in retirement. And we talked about that a little bit last week in terms of you take some of that money and you put it into pre-tax retirement accounts, which lowers your net income, and you only get taxed on it when you pull it out, hopefully when after you retire, and potentially you're in a lower income tax bracket, or your life situation has changed significantly. And let's say right now you need a family health insurance coverage, and round numbers, what's that going, $27,000-$28,000 a year now in Massachusetts? Pretty significant chunk of money. When you're older and the kids are out of the house, you might not need a family plan anymore, and those premiums could be quite a bit less. And so, pulling the money out then, even if it impacts health insurance, may have significantly less net cost to you, if that makes sense. So what I'm trying to articulate is that there's a lot of numbers moving around. There's a lot of options in terms of a way to use the money, and the easiest way to see that is to have spreadsheets with formulas, so you can change those numbers based upon the information experts tell you, or work with them to see what the net financial impact is. And you look at the numbers and you can pretty quickly assess what your net best financial position is by looking at those various scenarios. It's a lot of work. It takes time. Again, I don't want to discount the fact, right? Most of us aren't number geeks, right? I'm sort of a number geek, but not really, and it's not something that when I was farming full time that I did, because I was really busy, farming full time, and it wasn't the thing that interested me the most. But what I can say is, in all my years of farming and working with other farmers and observing other farmers and successful farmers, the folks that have been successful are the people who either figure out how they do it or get the support to have someone else do it, in terms of looking at numbers and doing this financial planning and projection, and making the decisions that show what turns out to net the best money for the business, and ultimately for you and your family as owners.
Great, thank you. Are there any questions? Any other questions? And I assume people can, if they've like very specific questions, they can reach out to you, Jeff. And we'll put your email in the chat again.
Yeah,
Um,
absolutely. Again, we can provide a little perspective informally on tax and other stuff, but we're not tax experts. And we're not lawyers, right? We talked about how you account. I talked a little while ago about whether it's accrual or cash. That's one element. I would conjecture that there are different strategies if you have a corporation for your business versus a sole proprietorship. Corporations, particularly corporations with accrual system accounting, can literally bring, let's say, grant money. They can bring grant money in, and yes, it's recorded as income, but at the same time, it's called the balance sheet. You record that as a liability. The grant says you have to spend this money. That's technically a liability, which means you are allowed to list it in the liability section. So for that particular year, the net result is zero on your income statement. And then as you spend it, you in equal proportions recognize the income and the expense at the same time, and of course they balance out to zero. So again, there's all these strategies that require, if you're not a bookkeeper or an accountant and you don't understand these things, it requires professional support. That I'm aware of. I'm aware of these things, but I'm not the person to actually provide that professional support. Just give you some ideas of what you should talk to professionals about.
And I also just dropped in the chat, next week's Lunch and Learn is Discover Financial Freedom, a workshop for farmers with Gather Wealth. And if there's no other questions, we will hopefully see you all next week. Thank you, Jeff.
Thanks, Susan. Thank you, Jeff.
Yeah,
Thanks, Jeff.
Sean,
Thanks,
Matt,
Sean.
did I
Thanks,
say anything
Matt.
wrong? Did I say anything you need to correct right now?
I'll call you
Before-
afterwards, Jeff. No, you were great. You're great. Thanks again.
Thank you. And Sean and Matt, I'll reach out to you about next week.
Sounds good, Susan. Thank you.
Thank you.
See you then.
Everyone for coming.
Bye, everyone.
Bye.
So, thank you.